strategic partnership and collaboration to support the financial growth and aggressively drive the technology-driven products such as internet, mobile, agency, and banking were in fact some of our successes in 2013. Increase in products and service portfolios across the group as part of our medium and long-term business drivers. These are mobile banking, bank assurance, investment banking, and Islamic banking. The deployment of successful contingency management to timely address any unexpected events that would slow down our set goals and objectives. The unfolding events in South Sudan, late December 2013, was not easy for the business to operate smoothly. Under the prevailing circumstances, however, our staff in South Sudan demonstrated courage, determination, and passion to serve our customers in the prevailing environment, which is highly commendable. We are optimistic that this will prevail following intervention from the African Union, Intergovernmental Authority on Development, IGAD, and the international community. I would like to take this opportunity to thank the board, the management, and the staff for working tirelessly together to achieve these good results. I also want to thank all our stakeholders, namely our customers for their business support, our shareholders for always supporting us, the government and regulators for their guidance, the media for highlighting the bank's journey to greatness, and the communities for standing by our side and giving us the opportunity to serve them. Without you all, we would not have achieved this great performance. Thank you for joining us this morning and for supporting our desire to become the Eastern Africa top bank.
I mean, our organization has been around for over 118 years. Over time, we continue to be an outlier in terms of continuously developing the region, integrating and catalyzing development. And that's a vision that the bank has had for a long time. It's a very compelling vision. I haven't seen another institution in our sector take that lead to bring in convergence for our businesses in the region. And that's an exciting move to be. So if you look at the real map for the group, we still remain in excess of 236 branches today, over 7,000, close to 7,000 agents across the region that operate. And I think that can only get better because we're in a very strong frontier market, a market where, as a collaborator that we work with, you find opportunities to be able to increase our business and our growth opportunities. But obviously, it's good to look at the environment where we are today. What business are we running? What exactly was the environment last year? If you look at our economy, the Kenyan economy, we are already pushing ourselves into the frontier market, or what you call a frontier economy. Not many of them in Africa. Look at Nigeria, either in terms of innovation, in terms of solution for our customers, our ability to enhance integration for our customers, and perhaps increase financial deepening. And that continues to be a very strong, prudent practice in the market that you've seen, whether it's on inflation you're looking at. That has been well managed within the national government targets of 2.5 to 7.5%. If you look at technology, and this is an exciting space, Kenya is well known to lead in mobile financial integration, particularly on mobile banking across many parts of the world. And that gives an opportunity for us to exploit and perhaps change our customers' expectations, our customers' experience, and lead new solutions and definitely new revenues for our customers and our shareholders going forward. The country has already gone ahead. I'm very much confident around raising the Eurobond the country has set up of $2 billion. Some delay, but that's definitely going to come and pass. And that is a strong confidence in what you see from the international community. The country's reform agenda is unstoppable, Chairman, where we are today. And overall, where last year we didn't achieve our growth targets overall at 4.9% focused on GDP level compared to 5.7%. But we are already ahead of the curve if I look at our targets for the last 2 to 3 years. And that can only be better, shy of the government target of 7% on 10% in the medium term. The issue that always comes in mind is about our interest rates. The challenges that we've seen in the last year, 2013, the whole industry and the bank led in bringing down interest rates by close to 700 basis points from the high of 23% to now an average of 16%. Of course, there will always be a way to look at interest rates, working closely with our partners, whether it's government, the central bank, the national treasury, and the banking sector. And KCB plays a big lead in that aspect. If you look at the region, this confirms what I said earlier, that our investment in the region continues to remain perhaps the most critical decision in our strategy, and we see many followers into the market that we continue to lead. So if you look at Uganda, for instance, Tanzania has been a strong outlier in terms of growth, GDP expansion over 7%, but generally we are growing way ahead, both Sub-Saharan Africa, EMEA region, and globally, as I show in the next slides. In terms of key sectors that drive the economy, and we participate in all these key sectors, not much has changed over time. Agriculture is a big backbone for our country. As you're aware, more than 80% of our people out of Nairobi are actually working constructively, directly, indirectly in that sector. If you look at transport sector, it's a very key area in communication. The wholesale and retail sector, which is more the trading side, manufacturing, and various other sectors. What you will see coming out in the going forward is the oil and gas, because that's an area today we sit in, as I keep saying, in an epicenter of growth in terms of hydrocarbons in this area. And perhaps it's 3-4 years ahead of time, but that is a key sector that will bring in a little bit of shift in the way we look at the buckets of GDP for the country. But KCB plays a big role in these sectors, whether it's agriculture, in transportation, in wholesale, real estate, mining, construction, and we continue providing a leadership role for products and solutions for our customers. So overall, if you look at the area we are, which is really the EAC as a bucket, where we are in each and every country, we're ahead in terms of our growth targets. We're ahead in terms of other markets, if you look at Europe, the US, and we've been like that for the last decade. And this is focused. If you look at the statistics from IMF, this is a focused strength for the next 10 years. So in short, we are in a good area today. A little bit about the industry. The role of the financial services sector cannot be underscored or cannot be overemphasized, because we stand at the nerve center of enabling economic activity. If you look at the banking sector overall in the last 5 years, today we are saying our number of customers who use the banking sector have more than increased by more than twice. If you look at agency banking, an innovation with the industry where we have got close to 7,000 agents, the banking industry has got to 30,000 agents right now. Over 310 billion shillings has been transacted in that channel. And this will be a new way of pushing transactions and consumer experience in the way we are operating. If you look at the amount of money that moves within the electronic payment system, it's 20 trillion shillings in the last year. That shows the amount of depth. This is almost half of GDP of this country. So ultimately, if you look at the electronic fund transfer, and what I'm more interested about is the card transaction values reaching 1.4 trillion shillings. This is shy of the 1.7 trillion shillings done by M-Pesa in the last financial year. So the bank's investment in technology, and I'll be talking a little bit more about the EMV conversion and integration to new channels, will bring in a new space as we move the country into more cash-light or non-cash payment system. And the card, for me, the 1.4 trillion, is a key indicator. It's growing at a much faster rate that you've seen before. And when the government talks about automating and going e-payments for all payments, the transport sector, for instance, you will see the banking sector and KCB taking a lead in that area through that kind of solution. We are now sharing credit information overall from the 1st of March. That is one way to try and bring down the rate of interest and give customers the rate they deserve from their credit scores. So a good customer who has a good score gets a better rate from another customer who has got a bad score. Of course, the industry converted check truncation last year, and therefore we are now doing T+1. In this year, most of us, including KCB, we should be able to see our customers already depositing their checks from the comfort of their homes, especially the customers who are on online banking. So that's the kind of innovation that the industry and KCB continues to make in terms of enabling our customers' experience. Let me talk a little bit more about the achievement for last year. We had 6 main ambitions last year. Is to enhance our customer leadership, enhance our customer experience. And for me, it's been exciting. We launched our M-Banki, the first innovative solution for our customers to open their accounts from where they are. And we've seen a lot of the younger generation, the students, the younger graduates from school, take up this product in a manner that I've seen us grow our customer numbers in the last year by close to 1 million additional customers in one financial year. That, for me, is a tremendous way of saying we can integrate solutions for our customers. If you look at technology, that has remained our own area of outlying our business. And I'm very confident that this will continue to be an area to invest into, to change the way our customers see us, to see the way customers access our services everywhere, and not just in Kenya, but in the region. In terms of efficiency, it's been a great story for the last 3 years since I arrived in the bank. Cutting down our cost-income ratio by 1,200 basis points is no mean feat for a bank of our size. So it's a great story. We took over to consolidate our group businesses last year. So overall, we didn't go into a new country, but remember, we have always been the first to take the group and to take Kenyan business in the region. So today, we're in 6 countries, and our role last year, and this year most likely, is to consolidate our businesses. And you will see that in our financial results, that our portion of international businesses are growing much faster, contributing much more share of the group's target. And we want to see them achieve 25% in the next 2 to 3 years. We completed our restructuring last year. In terms of investor relations, Chairman, it was a great story for our shareholders. I saw our shareholders' value increase by close to 71 billion shillings in one financial year. I probably know of one other organization whose growth was at that level, which could be Safaricom. So that's a strong experience. And what we do is translating what our shareholders see and improving their own returns in any year. We also got a credit rating. This is the highest rating ever awarded to a financial institution in this market. And that demonstrates the strength and capability of our institution. It's not all about money, making money and building much more returns, but it's about integrating our vision with the communities that we work with. Being in 236 different locations as branches and 7,000 locations as agents, it means we must be able to look, whether it's in Uganda where we're doing education across the group, whether it's in Tanzania or South Sudan where we're involved in hospital construction, supporting those countries which have got a vision of real partnerships to bring in value for their customers and the people that we are. We believe that to transform the region and the country, we must be a leader because this is our market. So the enterprise, which is running everywhere through the foundation, is an area we'll continue to invest into. So far, by the end of this year, we would have invested over 1 billion shillings through social investment programs through the foundation. And that money is all committed from the earnings that KCB makes, and KCB allocates 1% of its earnings into the foundation. It's an exciting area for me. I didn't talk about the school education program for sponsorship for our kids, the best kids who are unprivileged children who go into high school. So that's an area that we continue to perhaps grow that. We have got over 600 students today, and by the end of this year, we'll have close to 1,000 students in this program. We also get recognition, and this for me is a demonstration of what people who are independent look about our business. Being awarded last year as the best African bank by the banker, for me, was an epitome of a mark of appreciation of our transformation. It's the first time an East African bank has given a recognition as the best bank in Africa. Of course, we also won the Kenyan award. That for me is an exciting space. We have a lot of the other awards, but I'll pick up just one award, Chairman. And lastly, just to speak about what's really we're looking for, what is the unique aspect, what are the pillars that support the group's vision going forward. We continue looking at our 6 main pillars: innovation and technology. We look at still growing efficiency. We believe that we can bring our cost-income ratio to below 50% in the current financial year. So we should achieve 49.9%. And 2 years ago, we were at 63. I mean, that's an area we continue to perfect. We continue to consolidate our international businesses, enhance our customer experience through enhancing our customer satisfaction score, building our sustainability of our regional businesses, and as well as opening up new opportunities. I'll speak a bit shortly. So I was spoken about technology and innovation. I will not emphasize, but I say that the card space, the cash light moving to non-cash payment, is a space that you will see us playing much more aggressively, whatever the industry it will be, whether it's in the retail space, whether it's going to be on the transport space. That's an area we now have the right investment with converting ourselves to EMV compliance to be able to drive that agenda. And we've seen our transactions increase by more than 200% in the last financial year. If you look at the other aspects of efficiency, I've already talked about that. At 51%, Chairman, this is perhaps the best score we've seen in our group of our history. And in terms of like-minded banks, we perhaps are now starting to compare with institutions that we will say we are becoming efficient in our cost management. And 51.7% without the restructuring costs we had last year. At the regional level, all our countries continue to contribute. They're profitable. Our youngest subsidiary turned profitable after 6 months. And Kenya is contributing today 88% of the group. Last year, it was contributing 93%. So we're seeing strong rebound of our international businesses. I will speak about one market where there is always concern about what is happening in South Sudan. And I will encourage, I see South Sudan, the chair lady of South Sudan is here, Madam Charity. We've been in the market just last week. And sometimes we don't get the right information. We are writing the information based in Kenya. But out of our 21 branches, 18 of the branches are operational. They're running our customers able to access services. 4 branches, we decided to close them down for the time being in Bor, in Bentiu, in Malakal. It's a market with many upsides. Today we are 51 to 52% of the market. A year ago we were perhaps 47%. But the level of financial access is around about 2%. So for me, I would only say that because we have always been in countries to build development and capacity for the countries, we will continue to grow our businesses in a manner that manages our risks in the market. So we are optimistic in South Sudan today. We have challenges. There will always be challenges in the markets that we operate. Perhaps our experience as KCB is to operate our businesses profitably in difficult markets. That is what you see. You don't see that in other organizations. So our continuous customers, we never closed South Sudan business for a single day last year, except on Christmas Day. So that shows the ability. We have 400 staff who are running. The risk we see in the market is largely delay in launching about new innovative products in the market as to achieve stability. And we are engaging, as Chairman said, at government level, at senior level, at IGAD level, at our own head of state level, in terms of the collaborations and the solution of the issues that we see. So it's a good story for South Sudan. It's not a dent today in the performance of the group. So we will continue our business in South Sudan. In terms of customer leadership, we remained extremely innovative, and the card that you see there is really the new technology we're talking about, the EMV compliant cards we are issuing now. The whole industry is moving. We will be ready to move ourselves by the end of March. And that brings in new solutions to provide cards. You may have seen we launched a partnership with Nakumat last year with the Nakumat Global Card. And that gives you a chance to say how that space will play. We want to take more advantage on the payment system on small transactions going forward. And a lot of things I will not emphasize. Talking about sustainability, this is at the core heart of our institution. Whether you look at it from the way we do our business in the countries where we invest on an economic side of sustainability, an environmental protection, which is a key pillar for us, a financial stability in terms of the results we deliver, and in terms of the long-term social sustainability through the foundation. That aspect must be in a big spectrum of our business where we're operating. Lastly, the KCB is really growing its agenda to build a much more broad financial services institutions. So you may have seen just the other day that we were licensed by the Capital Markets Authority as an investment bank. And KCB Capital is one wing which naturally comes on to build on our customers' experience, bring in new aspects into the market, whether it's exploiting our real estate investment trust into the market, the asset-backed securities, the mortgage-backed securities. And because naturally those are our customers today, we are able to collaborate and converge their solutions today for our business. And that is how we establish our investment bank. It's about building the capacity of our businesses across the region to take advantage for them and give them an outlier role to grow in the region that we are. Of course, the insurance business, we now revamped our insurance business. We are seeing ourselves growing much more aggressively in that business all the way to the top value chain. Not just running an agency, but seeing ourselves to grow more and more into the insurance business. We are a large provider of insurance for our customers today, whether they are mortgage customers, retail customers, corporate customers. And those two will be a big engine, in my view, to grow the way the business is going to go forward. So overall, for your bank, I would say that we see ourselves sitting in a very defining space between the past, and we've been here for over 118 years, and a very impressive future for the next 100 years.
Let's look at the financial statement of the financial position, and let's start by looking at our asset portfolio. Now, our total assets over the year grew by 6%, which is about 23 billion growth. Now, that is a significant number in absolute terms. Now, the key contributors there, you can see net loans has grown by 8%, just shy of our 10% target for the year, but still quite impressive. Other components of the total assets that have grown include other assets, which have also grown significantly, and investment in government securities. Now, on your bottom right, you can see two charts there. What those represent is that if you look at the two charts, there's no significant difference, but you can see that our loans and advances constitute 58% of our total asset book. And we are saying that loans and advances together with government securities, which add up to 82%, represent interest-earning assets. So as a bank, we're actually churning our assets to the best we can. And that's a 1 percentage point improvement from last year, where we had 81% of our total assets being, contributing towards our P&L. If you look at the asset growth, well, we're saying that we've had a compounded growth rate of 13% over the last 5 years from our net loan perspective. This is quite impressive. Now, there has been challenges, of course. There's been a lot of talk. And in 2012, we didn't probably notice a significant growth in our net loans, mainly because of higher interest rates. You notice what happened back end of 2011 and early 2012 when there was tight liquidity in the economy, and hence interest rates rose significantly. But on the NPL ratio, I'd like to say that we are working extremely hard. We've reduced that by 3.3 percentage points. It's quite significant. Our Kenyan business actually has improved our NPL. We are at 7.4%. And due to the incidences that happened in South Sudan, I can assure you that we've taken and made appropriate provisions, and that has taken back our NPL to 8.1%. However, that is still impressive. It's an area that we are really focusing on, and we have strategies in place to ensure that we address the NPL position. Our target for this year is 6%, and we hope that we'll achieve the 6% by end of this year. On the composition side, there's not much change from previous year. The business is still heavily corporate, with 44% of our loan book being on corporate, but we're also in other sectors as well. And as you can see on that chart, the micro sector constitutes 28%, which is quite significant, and the other sectors are also represented very well. The coverage ratio, which has been a key point of discussion, has slightly improved to 59%. I think the most important thing to note is that there's an inverse relationship between coverage and NPL. And we can see that given that our NPL has reduced, our coverage has gone up. However, as a business, we want to ensure that we are adequately covered. Our target is probably 65% by end of this year, and in the medium term, to achieve an 80% coverage level. One area that is really of key concern is on provisioning. And I remember 2 years back, probably back end of 2012, there was a report by one of the analysts that Kenyan banks are not making adequate provisions. What this slide tells us is that there's a clear difference between prudential guidelines and IFRS reporting. Now, as a business, our provisioning is made under prudential guidelines, which is quite strict and very stringent. However, for reporting purposes, we report under IFRS, which is the global reporting standards. Now, there's a clear difference between those two. What comes out is that because of the stringent nature of our central bank regulations, we end up making in excess provisions under CBK. Hence, that excess is reclassified to an account which is referred to as a loan loss reserve account. So on your bottom left, you can see that to date, we have accumulated balance of 4.3 billion. What that means is that over the years, if IFRS was in compliance with prudential guidelines, these numbers would have gone through our profit and loss. However, they're in a reserve account which are restricted, so the balance is not distributable. Hence, there's no difference whether they would have gone through P&L or whether they sit in this reserve, because either way would have taken them to an accumulated reserve in the liability side of our balance sheet. On your bottom left is just graphical, or rather pie charts, just showing you the difference between the CBK and the IFRS provisioning. If we look at the funding side of our book, you can see that our total liabilities have grown by 6%. Clearly, the main factor there being customer deposits, which have grown by 6%. And it's important to note at this point that during the year, in 2013, we deliberately retired close to 15 billion of very expensive deposits, or high-cost deposits for that matter. And therefore, this customer growth would have been a double-digit growth. However, to manage to balance, the performance of the business vis-a-vis the deposit balance, that's a strategic decision that we had to take. So we are focused. We want to grow our deposit by 21% this year. It's achievable. I'm sure you'll probably wonder how that is achievable. The CEO has talked about the themes that we have in place for this year. M-Banking is one of our key drivers to mobilize deposits. We have other alternative channels, agency, mobile. So all those will help us drive the deposit mobilization. The shareholders' funds have also increased by 17%, principally because of the retained earnings, which have been reclassified from year-end profit to a retained earnings classification. It's also very important to note that if you look at our liability book, 78% of our total liability is customer deposits. Now, as a business, that is the area we want to operate in. We are a savings bank, and we have to ensure that customers are actually saving with us. And the savings then help us to fund our asset book. From a customer deposit perspective, we've had a compounded growth rate of 13% over the last 5 years, maintaining a loan-to-deposit ratio of just under 80%. Now, it's important to note that central bank are reviewing the loan-to-deposit ratio. The standard is not out yet, but the discussion is around a max of about 80%. So as a bank, we are compliant and we want to operate at that level going forward. On the deposit type, you can clearly see that about 42% of our deposits are actually current, with 28 in savings and another 28 in our fixed deposit classification. Our stress test clearly revealed that even though we classify this as current deposits, they're actually long-term deposits. The fact that we don't have contracts with our customers, which will fix this as long-term deposits, we've tested and ensured that over the years, actually these deposits are not withdrawn. So they sit with us over a longer period. By sector, you can see that corporate still contributes over half of our total deposits, with personal and SME deposits very close behind. Our strategy, of course, is to grow our SME, personal and micro sectors, and hence we'll be trying to mobilize deposits in that sector. So you'll see a slight reduction in the corporate deposits through a composition perspective, but not in real numbers. The charts there clearly just demonstrate our deposit classification, and as I've explained, even though the current deposits are classified as less than 1 month, they're actually long-term deposits, and hence there's no mismatch between our liabilities and our assets. One key area that is normally of concern is whether the bank is adequately capitalized. And last year, Central Bank released prudential guidelines which become effective on the 1st of July this year. Now, as a bank, we took a decision to actually adopt those regulations well in advance so that we can tell where we are before the 1st of July when the regulations become fully effective. From a core capital perspective, the changes were that the limit was raised from 8% to 10.5%, and from a total capital perspective, the limits were raised from 12% to 14.5%. As a business, we've worked out our capital ratios, and on the core capital side, using the new prudential guidelines, which are actually Basel II compliant, we are at 18.5% against a limit of 10.5. However, if we had relied on the old prudential guidelines, which are still effective, by the way, would be at 23.5%. On the total capital side, we are at 22.5% on the new prudential guidelines, and if we had relied on the old prudential guidelines, we would be at 28.2%. Now, the chart, the table on your bottom left just demonstrates what are the key changes. You can see that the risk-weighted assets is where the impact is. And under all prudential guidelines, we are saying our risk-weighted assets would have been 212 billion shillings. However, the new changes to Basel II requirements introduce 2 new risk elements, market risk and operational risk. So if you take those 2 into account, our risk-weighted assets amount to 272.6%. And because this is the denominator in the formula, it then reduces your capital and core and total capital ratios. What I'd like to say at this point is that as a business, we have in excess of 21.7 billion capital to finance growth for future expansion. And this is under the revised prudential guidelines. Let's move to the comprehensive income, otherwise known as income statement or profit and loss. I'm happy to say that as a business, we have reported a 17% increase in our profit before tax to close at 20.1 billion shillings. I think we deserve an applause for that. The main contributors, you can see net interest income has grown by 8%, with other income also following closely, gross commissions following closely at 9%. Other income growth is 52%, but the numbers are not that significant. The profit after tax growth is more or less the same as profit before tax because our tax rate is 30% in both years. If you look at the ratios at the bottom of the income statement, our net interest margin has actually reduced from 10.9 to 10.1%. This clearly demonstrates that as a business, our interest that we charge customers has actually gone down in 2013. So the profit that we have delivered is not because we've been charging excessive interest. Actually, we have charged lower interest than we've done in the prior years. On the cost-income ratios, the CEO talked about the ratio, so I'm not going to spend any more time on that one. But the cost of risk is maintained at 1.3%. This is quite impressive. That means that for the new loans that were written in 2013, the probability of them going bad is only 1.3%. And our projection for the next year is the same ratio of 1.3 to 1.4%. So we will try to ensure that our NPL does not grow beyond where it is as we deal with the legacy loans that we have. So that will help us reduce the NPL ratio. The return on assets is stable at 3.8%, slightly above last year at 3.1%, with return on equity at 24%. Slight decrease from last year, but that's mainly because of the dividends that have been proposed for this year, which are higher than what was proposed in the prior year. The business drivers improved Kenya performance. I think it's important to note that Kenya as a business has actually improved its performance. And as at Q3, the other banks have not reported their Q4 numbers. But I'd like to say that as at Q3, based on the numbers we have, the Kenyan performance is better than any other consolidated bank in Kenya today. I think it's important to note that. And I hope that when the other banks report us at year end, the same will be true. So at this point, I'd like to just recognize our MD for Kenya, Mr. Sam Makome. There has been improved performance by our international businesses. They have contributed 11.5% to the total group pot. Last year, they contributed 8.4%. So that is tremendous improvement. Growth in net interest income boosted by growth in loan book, which I've talked about, and securities trading income as well. PBT growth is 17%. Reduced cost of funds, we are at 2.8% from a cost of funds perspective, and we will continue to ensure that we mobilize low-cost deposits so that we manage the cost of funds. Remember, the net interest margin I talked about is made of two factors. One is cost of funds and the yield on your loans or government securities. So from the revenue side, we've had a compounded growth rate of 16% over the last 5 years, with our net interest margin, of course, which I've talked about, closing at 10.1%. On the operating cost, a compounded growth rate of 11%. Now, it's important to note that as a business, what you want to say is that the rate at which your revenue grows has to be higher than the rate at which your cost is growing. And from the previous slide, you can see that our revenue have been growing by 16%, and the costs have been growing by 11%. You want to see the jaws actually widen. If they move parallel, you are struggling. If they approach each other, you're out of business. On the staff cost, I think it's an area where we are trying to manage our staff cost, and I think the ratios there demonstrate where the market really is. The industry average is between 27 and 30%, and we are just within that range. And the charts there just demonstrate our breakdown of the operating cost. So I'm not going to go into those in higher detail. But for us to ensure that we transform our cost base, we will place heavily reliance on technology and innovation. And the CEO talked about some of the things that we are trying to do. We have a robust core banking system and a few other alternative channels that we are trying to drive the business through. Shared service center, a very robust shared service center to ensure that we centralize costs. Operational efficiencies, we have to ensure that we keep driving operational efficiencies within the business, and alternative channels, which I've mentioned earlier. Profitability, we've had a compounded growth rate of 26%. We've now closed at 20.1 billion PBT. And if you look at the performance by the international business as well as Kenya, you can see on your left, this is last year's performance. Kenya really contributed significantly, 91.4%. But we had a few subsidiaries that actually made losses. If you look at Burundi and Rwanda, they actually made losses. And even their total contribution to group was actually very low. If you look at the chart on your bottom right, as at 2013, you can see that the contribution by Kenya has reduced, And that's mainly because the international businesses has contributed more. They have done better than they did in the previous year. And all of them are actually profitable. All of them are profitable. That's where we want them to sit. And we want to ensure that we drive efficiency across the whole group, not just Kenya, but in all our international businesses. In summary, there's a slide there on the key statistics. I just want to mention a couple of those statistics. Market capitalization, we closed at 141 billion. But during the year, we had a high of 150 billion. So we are still the most capitalized financial institution in the region. And you can see the significant movement from 2012. It just shows the growth in our share price. And we thank you as our investors for having contributed to that.
The results were quite good and quite exciting. So at this time, I'm going to give us a few 10 minutes so that we can be able to give our comments and questions. For the media, I'll request that we hold on, because after we've released our guests, then we'll be able to have a session with you on a one-on-one. So at this time, I just request our guests, if we have any comment, this is the time. I have people who are moving around with the microphone, and the CEO will be here to take the questions. Thank you.
Just to add on, that the board declared, as proposed, a dividend of 2 shillings per share at the end of the financial year 2013 for all our shareholders. I'll take some questions.
Good morning. My name is Jad Murigi from African Alliance. Congratulations to Joshua and the team for those excellent results. Just one question. I've been hearing about a new CBK prudential guideline whereby if a borrower misperforms on one loan, his entire facilities are classified as NPL. What kind of impact is that expected to have on KCB and the banking sector in general? Thanks.
Thank you, Jad. We'll take a few more questions.
For sure, congratulations are in order.
Thank you.
As a shareholder, I came for a little bit more than 2 bob. Why are we holding so much in reserve? Why don't we capitalize and share a bit of that to shareholders? That's one of the things I came for this morning.
Thank you. So, Jad, thanks for the questions you asked about the new guidelines. But if you look at what you've been doing as a sector, generally our loan facilities for the same customers are consolidated in terms of review. So, if you're looking at saying, if one relationship today did not perform, the entire portfolio is then assessed collectively together. That has been our practice today as a sector. It's not changed. So perhaps you're looking at, for us as a bank, that has been our philosophy in terms of putting together the facility for a relationship for a customer together. Whether it's one entity is performing, another one is not, we actually look at them as one entity and deal with them consistently at the same level. So yes, I've seen a lot of communication, especially in the media, about the new guidelines to change. Maybe it's just to make sure that becomes the standard in the industry, that everyone applies the same guidelines, the same rules. Remember, there are many things that KCB provides an outlier positions. I'll give you an example. On Basel II, we already complied earlier 2 years ago because we said we want to be self-compliant. We want to drive the way we see our business can be benchmarked in the region, largely because a number of our investors and interested are very international. They want to look at the comparability of our business with another business in other markets, in EMEA region, in South America region, in Europe, and even in Africa. So the areas we've been trying to drive that, and for me, I'm excited to see that kind of standardization happening together at this year from the central bank. So I would say we're already ahead of that. It's important that it's already coming now to support the industry in terms of benchmarking. Thanks very much, shareholder, for coming. We always look at dividends to say, I think it's an issue we will continue to address, particularly in terms of the future of our reserves, our bonus issues going forward. And it's a matter actually that we'll discuss with shareholders at our annual general meeting. But at the moment, if you look at the amount of dividends that we pay, is by far the highest level of dividends we pay than just in the banking sector. The only other person perhaps is a telecom company. But for us, we will be, if you look at our proposed increase of dividend, it's a significant amount in terms of sort of value. And yet, the group has got vision to continue to grow and strengthen the capacity of your own institution. Our view has always been that capitalize the opportunities. If you look at whether we are going to insurance route, we are going to strengthen our regional businesses. I look at it 2 ways. One is on the dividend side, but 2 in terms of the size of your institutions, the value of your institutions. Bringing close to $1 billion worth for our shareholders in terms of the valuations, for me, is an exciting space to be today in our business. So thank you very much for coming and hosting us. And being the first bank to achieve the 20 billion mark in terms of profit in our history, I think deserves commendation. Thank you very much and have a good day.